oil has failed to recover from the last week's sharp drop and continues to trade near its lowest levels since May. That is, the asset is moving in the area posted before February 24. At the same time, concerns about the looming energy crunch remain. Moreover, they are just mounting. In addition, global tensions continue to rise. Against this background, oil should have been gaining value, but this is not the case. Apparently, this is due to strong speculative hype. Given that the current behavior contradicts all available long-term factors, this means that oil may well resume its bullish run soon. In addition, this could be attributed to the news that China, the world's top crude importer, imported 8.79 million barrels per day of crude in July, which is 9.5% lower than a year ago. All this stems from restrained demand in the face of global recession fears. According to the trading chart, Brent crude oil futures eased the pace of its downward movement around the level of $93 per barrel. As a result, the volume of short positions decreased, which caused a pullback. Nevertheless, short interest is still ruling the market. A sell signal will be generated after the price returns below the current pivot point. Until then, the benchmark is likely to continue pulling back to trade in a range in the short term. Upbeat data on the US labor market affected gold, which slid to the area of $1,775 per troy ounce, and this situation is likely to remain unchanged until the next meeting of the US Federal Reserve. Investors are hoping to receive some clues about the regulator's plans regarding the pace of a further monetary policy tightening. Thus, the yellow metal is expected to continue drifting around $1,800 per troy ounce within the next months. A pullback phase, coupled with a variable growth in the volume of short positions, will continue until the quote consolidates above the key level of $1,800, at least on the forward chart. Meanwhile, the Russian currency has been standing still for the third week in a row, hovering around 60 rubles per dollar. Notably, sharp fluctuations in both directions are becoming increasingly rare. It turns out that the measures taken by the Bank of Russia earlier were insufficient to exert strong downward pressure on the Russian currency. At least the regulator managed to limit its rampant rally. Now, market participants are awaiting further steps from both the central bank and the Ministry of Finance. The latter is expected to ease the restrictions introduced in early spring. In this case, the ruble will most likely post steep losses. At the same time, judging by the outcome of the last meeting of the Bank of Russia Board of Directors, a further cut in the key interest rate will barely affect the national currency. However, if the Ministry of Finance delays its decision again, the ruble will resume gains. A buy signal will be generated after the price consolidates above 61.50, and in this case the greenback will have a chance of rising to the area of 62.50 and 65.00. A downtrend scenario will be relevant if the price fixes below 58.50. And that's all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you soon!